The clock is ticking on a financial time bomb that could reshape the American economy, and almost no one is talking about it with the urgency it deserves. We are standing on the precipice of what industry insiders are calling the maturity wall, a staggering $5 trillion in commercial real estate debt that is set to mature by 2025, with the fallout extending through 2027. This isn't just a big number. It's a colossal existential threat to the stability of regional banks, the value of downtown cores, and the retirement funds of millions. This is the story of how a perfect storm of cheap money, pandemic-era shifts, and aggressive interest rate hikes has created a crisis where borrowers can't refinance, banks can't afford to take the loss, and the entire system is bracing for impact. This is not a drill. The sheer volume of debt is unprecedented. For context, the entire US residential mortgage market is vast, but this $5 trillion is concentrated in a sector that is currently under immense pressure. Think of it as a massive dam holding back a flood of financial obligations. That dam is now showing cracks, and the water is about to burst through. The core problem is simple. These loans were taken out years ago when interest rates were near zero and property valuations were soaring. Now, as they come due, borrowers face a brutal reality. Interest rates are 5, 6, even 7 times higher than they were, and the value of the underlying assets, especially office buildings, has plummeted. This creates a massive gap, a repricing cliff, where the new loan amount is far less than the old one, and the borrower is left holding the bag for the difference. If you're invested in the stock market, if you have a savings account at a regional bank, or if you simply care about the health of the economy, you need to understand this. The commercial real estate market is the silent engine of local economies, and when it seizes up, the ripple effects are felt everywhere. This video will break down the 3 critical factors driving this crisis, identify the sectors most at risk, and, most importantly, tell you where the smart money is moving to profit from the coming distress. The first critical factor is the interest rate shock. For a decade, the Federal Reserve kept rates artificially low, creating an environment where borrowing was cheap and easy. CRE investors gorged on this cheap debt, often taking out short-term floating-rate loans or loans with balloon payments, assuming they could simply refinance when the time came. That assumption was shattered when the Fed began its aggressive rate-hiking cycle to combat inflation. A loan that was refinanced at 3% a few years ago now requires a 7% or 8% rate. This change fundamentally alters the math of commercial property ownership. The debt service coverage ratio, a key metric banks use to assess a property's ability to cover its mortgage payments, has evaporated for many properties. The cash flow that once comfortably covered a 3% mortgage is now insufficient to cover a 7% mortgage. This isn't a problem of poor management, it's a problem of macroeconomic policy shift. The cost of capital has made many previously viable projects instantly unprofitable. The second factor is the valuation collapse in specific sectors. While the $5 trillion figure is daunting, the crisis is not uniform. It is highly concentrated in the office sector. The work-from-home revolution, accelerated by the pandemic, has fundamentally changed the demand for office space. Vacancy rates in major metropolitan areas are at historic highs, and the value of older, less desirable Class B and Class C office buildings has fallen by 40% or more in some markets. When a loan matures, the bank must re-underwrite the property based on its current value. If a building was valued at $100 million when the loan was issued, but is now only worth $60 million, the bank will only lend $30 million to $40 million. The borrower is suddenly on the hook for a $60 million shortfall, which they often cannot cover. This is the mechanism of default. The third factor, and perhaps the most insidious, is the concentration of risk in regional banks. Unlike the 2008 crisis, where the risk was spread across the global financial system via complex derivatives, this crisis is heavily weighted on the balance sheets of smaller, regional and community banks. These institutions are the lifeblood of local CRE financing. They hold a disproportionately large share of the maturing CRE loans. When a borrower defaults, the bank has to take a loss, which eats into its capital reserves. If enough loans default simultaneously, the bank's solvency comes into question. We saw a preview of this with the collapse of Silicon Valley Bank and Signature Bank, though their issues were broader. The CRE maturity wall presents a slow-motion, systemic risk to this tier of the banking system. Regulators are watching closely, but the sheer volume of debt makes a clean exit impossible. The banks are incentivized to extend and pretend, to modify the loan terms and push the maturity date further out, hoping that rates will drop or property values will recover. But this only delays the inevitable and keeps zombie properties on the books, stifling the market's ability to clear itself. Now let's look at the numbers and the timeline. The $2.5 trillion figure is a consensus estimate for the total debt maturing between 2024 and 2027. The peak of the wall is widely expected to hit in 2025 and 2026. According to the Mortgage Bankers Association, nearly $1 trillion of commercial mortgages held by lenders and investors are set to mature in 2025 alone. This includes loans held by banks, life insurance companies, and those packaged into commercial mortgage-backed securities. The CMBS market is particularly vulnerable because these are securitized loans, meaning they are pooled and sold to investors. When a loan in the pool defaults, the investors take the hit. The structure of CMBS often makes it harder to modify the underlying loans, leading to faster foreclosures and distress. The market is currently bifurcated. On one side, you have the distressed assets, the empty office towers, the struggling retail centers, and the hotels that never recovered. On the other side, you have sectors that are not only surviving but thriving. Industrial properties, driven by the e-commerce boom and the need for logistics and warehousing, are performing exceptionally well. Multifamily housing, despite some recent softening, remains robust due to a persistent housing shortage. Data centers and specialized medical office buildings are also showing resilience. The smart money is not abandoning CRE, it is simply rotating out of the old economy and into the new. This is a critical distinction. The crisis is not a CRE crisis. It is an office and retail crisis, amplified by a rate shock. The narrative of "don't panic" is gaining traction among some of the largest private equity and distressed debt funds. They argue that the market is simply undergoing a necessary repricing and recapitalization. They see the $2.5 trillion wall not as an obstacle, but as the single greatest investment opportunity of the decade. These funds, armed with billions in dry powder, are waiting for the moment when banks are forced to sell distressed loans at a deep discount. They can buy the debt, take control of the property, and then invest the capital needed to convert the outdated office buildings into residential units, labs, or other high-demand uses. This process of creative destruction is painful, but it is how the market corrects itself. However, the speed of this correction is the key variable. If the banks can successfully extend and pretend for too long, it will prolong the pain and keep capital locked up in unproductive assets. If the correction happens too quickly, it could trigger a wave of regional bank failures and a credit crunch that spills over into other sectors of the economy. The Federal Reserve and other regulators are walking a tightrope, trying to manage a controlled burn rather than a wildfire. Let's dive deeper into the mechanics of a CRE default. When a loan matures, the borrower typically approaches the original lender or a new lender for a refinance. The lender performs a new appraisal and a new cash flow analysis. If the property's value has dropped significantly, or if the new, higher interest rate makes the debt service unsustainable, the lender will refuse to refinance the full amount. The borrower is then required to inject a massive amount of new equity, the shortfall, to bridge the gap. If the borrower cannot or will not provide this equity, they default. The default process is slow. It involves forbearance agreements, loan modifications, and eventually foreclosure or a deed in lieu of foreclosure. This is where the distressed debt funds step in. They are not interested in the property itself initially. They are interested in the debt. By buying the debt at a discount, say 60 cents on the dollar, they gain control of the property's future. They can then work with the borrower to restructure the loan, or they can push for foreclosure and take ownership of the asset which they acquired at a significant discount to its original value. This is the opportunity side of the maturity wall. The impact on local governments is also a major concern. Commercial properties are a huge source of property tax revenue for cities and counties. A 40% drop in the value of downtown office buildings translates directly into a massive drop in the tax base. This will force local governments to cut services, raise taxes on residents, or both. The decline of the downtown office core is not just a financial problem. It's a civic one affecting everything from public transit funding to school budgets. So, what should an investor do? First, understand that this is a highly localized and sector-specific event. Avoid broad-based exposure to CRE, especially through index funds that are heavily weighted toward the struggling office and retail sectors. Second, look for opportunities in the resilient sectors. Industrial REITs focused on logistics and data centers are well positioned. Multifamily housing in high-growth, supply-constrained markets remains a strong long-term bet. Third, and most aggressively, look for ways to invest alongside the distressed debt funds. These funds are often closed to the average investor, but publicly traded companies that specialize in loan servicing, distressed asset management, or property conversions will be the beneficiaries of this market dislocation. The final takeaway is this: the $2.5 trillion maturity wall is real, and it will cause significant pain. It is a necessary cleansing of the excesses of the cheap money era. It will not be a sudden catastrophic event like 2008, but rather a slow, grinding process of defaults, foreclosures, and recapitalizations that will play out over the next 3 to 5 years. The key to navigating this is not fear, but precision. Understand where the risk is concentrated, regional banks and outdated office space, and where the opportunity lies, distressed debt, industrial logistics, and creative conversions. The wealth transfer that is about to occur in the commercial real estate market will be one of the largest in a generation. Those who are prepared will not just survive the storm, they will own the landscape that emerges on the other side. This is the time to be cautious, but also the time to be bold. The next few years will define the future of commercial real estate.